we're taught what to think and not how to think, I reckon. Anybody wanting to build wealth needs to learn this stuff.
Pete Matthew is a chartered financial planner and founder and host of Meaningful Money. He's also the original personal finance content creator. I said, you are our father.
You're the godfather.
You are the father.
The OG.
We're all your sons.
Yeah.
We are all your sons.
I had zero money lessons from my parents. They would dispute this, but it's unequivocal. Money was a taboo subject in my house. The first step to changing anything is awareness, right? So the fact that I can't breathe and tie my shoelaces at the same time makes me aware that I need to lose some weight, right? So I think if we start with awareness.
I came into the conversation thinking, we're going to talk about finance in the traditional sense of, planning, advice and things like this, because I know that content from you very well. I see it all the time and you're always really measured and balanced and you just kind of go, these are the facts. I think some of the best examples of the content you make are explanations around pensions as an example, really complicated, but you just drill it down and distill it. But then I started consuming all of the other content around you and it just became very aware that you're like a great thinker, in terms of, no, it's like elements of stoicism and just a reflection on self. And I thought this is fascinating that we've got someone who's a qualified financial advisor with life experience that's really into talking about self, decision-making, and just being the best person that we can be. And I think that can often be missing from the financial space in terms of chat because everyone wants to know the how, but they don't necessarily know the why or what do I do long-term. And that's what I'd like to focus on today.
Cool. I'm excited to talk about that. When you say with life experience, that's just a euphemism for getting on a bit, right?
You're not as old as this guy. This guy's like 50.
Yeah, black don't crack. You can't be getting my pension soon. Don't worry about me.
Yeah. I didn't know. You just come across like quite. You say it chill. I mean, cool. and I think that's a lot of the finance space is full of panic, right?
Oh my God, it drives me nuts. I'm glad that comes across, man, because money is so intrinsically tied with our well-being and our sense of self that it's an inevitable shift for me. And that's what's become the most important thing for me as I kind of transition in my career away from giving one-to-one advice, because I've got to run the business more now. My practice manager keeps telling me to not take on any more clients personally, so that's fine. And instead really focus on this stuff. And also I think it's a reflection of my own journey. So I'm raised evangelical Christian. My dad was a pastor. And I've really deconstructed a lot of that in my mind. So that's obviously entirely unrelated to finance, but it's taught me to question how I think, which I think is something we don't do enough as adults. We're taught what to think and not how to think, I reckon. So I think that's just a journey that I'm on personally. So it inevitably sort of comes out in the content that I put out.
Yeah, it's a fascinating upbringing. We'll get into it in a bit and how that informs your decisions and how it shaped the way you think about things. But can we start with quite a broad, simple question? Do you think people are hardwired to make bad financial decisions?
I think we're not wired to make good financial decisions, which I think is a subtle but important nuance there. So, I mean, I think we probably ought to define what a good or bad financial decision is. And a bad one is something that kind of makes us worse off, either in the immediate term or potentially longer term. And those bad decisions generally are knee-jerk, quick decisions or reactions. Finance, by definition, because it's such a long-term thing, certainly, good habits to build wealth, most of us are not going to win the lottery, become Premiership footballers. We're not going to get rich quick. Most of us get rich more slowly. And because it's a multi-decade endeavor, we are to think over multiple decades is not how we're wired, at least not in a fundamental sense. We're obviously capable of that, but we have to do that intentionally. I think we're more likely wired to be sort of fight or flight, instant response. Something happens, we got to do something instead of taking a beat, thinking about it and implementing intentionally. So I talk about being intentional all the time. I just don't think we're built to do that naturally. It's something we've got to work on, I think. So rather than being sort of wired to make bad decisions, I just don't think we're wired to make better ones. We need to kind of fix that wiring and work on it as we get older.
Because in the context of evolution, which I know you've looked at as well as part of your understanding of self, most men would be dead by 35. throughout most of history. So
I mean, all of history, compared to, except for the last less than 100 years.
Yeah, I don't know if women were slightly longer, but I bet life expectancy was still below 40, right, for women as well. So yeah, thinking to 65, 70 is pretty alien. Thinking to 100, which is kind of retirement planning now needs to think to those kind of levels, doesn't it?
I mean, it's it makes no sense to our physiology to think that long term. We're also in a world which is just impossibly complex compared to the world that we evolved in, where our social circle was the sort of immediate tribe, obviously going back to prehistoric times, but even, latterly, we were just talking about where we're both from and stuff. And I mean, even just like 2 or 3 generations ago, I live in the far west of Cornwall, people never went anywhere. They never went past Truro, let alone up here to London, just because it was really difficult to do that. And so they just couldn't conceive of a world which was bigger than their immediate circle. Whereas if we've got to invest in global equities and try and sort of have a thought of, the macroeconomics and what the impact of the American election is going to be and all that sort of stuff, that just is enough to blow our sort of lizard brain. Really, I just don't know how we can do that without really working on it intentionally. We said sort of earlier on, we're kind of taught what to think and not how to think. So, I spent 15 years producing content around the basics of finance. I'm convinced that if you get the basics right for long enough and consistently enough, you'll be okay, despite an increasingly challenging world and, all the stuff that we talk about all the time. But if very often we limit ourselves, I think, and we say, well, the world is what it is. I'm never going to be able to earn any more. I'm never going to be able to buy a house. I think that's a sort of limiting factor. And if we surround ourselves with people who say the same stuff, that's where our socialized mind, I think, is going to be limiting and limited into what we can achieve. But if we push through that and say, well, actually, I will learn how to be a better investor. I will learn how to put in place sort of decision crutches, I want to say, sort of ways that I can pre-think my decisions. I will learn how to do that, and I will become better with my finances as a result. We can do that. We just need to decide to do it and then push through.
Yeah, one example, not as nuanced as this, but the common exception that the S&P 500 is all that you need as an investment, and then versus say like a global index. I wonder if there's elements of this. Because Warren Buffett said it, didn't he? And Warren Buffett comes from a perspective of the American market was all he needed.
Exactly.
He's ridden the American market through the best period of the market, long term. Is that how many people consider outside of that and go, is that the case? Will it always be the case? These kind of ingrained kind of beliefs are logical. They're backed up by data.
Yes.
Going back 100 years. And, you can sit and go, well, look, how do we step outside of that? To really challenge ourselves on those views.
I think the great thing about some of these things is that you probably would be all right if you only invest in the S&P 500 for the rest of your life. Mm-hmm. I think part of the sort of polarization is like, this is right and that is wrong. And I say on the podcast all the time, I really don't like the word should. I don't like the word best. What's the best thing to do here? Where's the best place to invest? So I don't know. There's a million options, and they'll probably all serve you all right. But if you want to dig deeper and talk about factor investing or momentum investing, all that sort of stuff, then fill your boots, right? And you can really go down a rabbit hole and learn more about that. But that just doesn't interest me. But that's just the way I'm wired. I'm a lazy investor fundamentally. So I think there's nothing wrong with, in fact, quite the opposite. There's real merit in simplification and helping people to sort of reduce the number of things that they have to think about. Because you and I all know, if we spend less than we earn, there's tons of nuance behind that. If we make sure we're insured against the worst happening so that we can't earn anymore, right? Make sure that we insure against that. And then we invest wisely is how I generally put it. And again, there's tons of detail behind that. If you just do those 3 things, you'll probably be fine. Mm-hmm. But within those things, you can get as nuanced and as complex as you want. And you'll be neither right nor wrong. There's just loads of ways to skin the cat, right?
Yeah. And what you'll find is that most people will spend too much time talking about those things, whereas the activity that would have produced the better returns is go get a promotion, go work harder at your job,
Totally.
go earn some extra money. Don't try and debate, the returns on markets over centuries, because you're not going to change it.
No, exactly. Should I have 3 or 5% in gold?
Yeah.
Oh my God! I neither care. Neither does it matter.
Yeah.
You'll be fine either way.
Yeah.
Or 0%.
But get a 3 or 5% pay rise, and that'll change your life.
Oh my God!
And
those are the things that matter, right?
Yeah.
Definitely.
But you mentioned in your podcast that there are some like objective truths, and that even though it is the truth, well, objective truth, people still choose to not listen to it. So, like for example, the stock market. I think you said like every 3 out of 4 years, 3 years the stock market goes up, 1 year it goes down. But when it goes down, people still like have the panic and like, oh, I need to sell. I'm seeing negative. I'm seeing red. I need to sell. That's their like base reaction. But then how do you kind of combat that initial reaction and then say, okay, I want to sell, but my mind tells me that over a while the market should go up as it's been doing, so I should therefore not react.
Yeah,
how do you control that?
That's a great question, T, and I think it's one that anybody wanting to build wealth needs to learn this stuff, because it can be objective truths, but it's only abstract until you've got real money on the line. Right?
Yeah.
And so, I mean, even at the other end, we're potentially talking about more inexperienced investors might experience that. But even at the other end, I tend to deal with the sort of at retirement or in retirement space. But even that, these people have been investing for 30 years, and even they freak out when the market has a real worry. Usually they might come at that from the point of view of, well, I'm not working anymore, so I can't earn the money to make it back. But sort of absorbing objective truths definitely comes with experience, right? I mean, there's no real sort of substitute for having your own money in the game and watching it and learning from it. But if all you're doing is reacting as opposed to considering why something has happened, how you feel about it, and putting some space, it doesn't need to be long, between the event happening, 13% fall in one day in markets or whatever, between that event happening and you doing something about it, if you can only find the space to take a breath for like half an hour while you think this stuff through, and very often it's enough to sort of bring your higher order thinking into play and be able to say, what do I know about this? I know that markets go down 1 in 4 years, calendar years. And so this might be one of them. I know that markets fall by 10 or 15% every year, intra-year. So this is probably just one of those things. I know that for decades, global equities have, built wealth, investing in the great companies of the world, all the stuff we talk about all the time. I know this, but I used to have 25 grand in my ISA and now it's showing 20. And that's really annoying, because I've worked hard to build that money. And so, we need to think, right, okay, have I lost anything? Very often I'll say to people, look, you're sitting in a house, right? You paid 250 grand for it, right? You've done a bit of work on it. You kind of hope it's worth 300. You've got a mate who's an estate agent, and he comes around and says, you ask him, what's it worth? Right? I bought for 250. I've done a bit of work. You're hoping it's worth 300. But your mate who's an estate agent comes and says, well, unfortunately, there's a crack den that's just opened up behind, and there's a bit of subsidence in the area, so actually houses like this are only going for about 220 now. So you think, well, crap, I've bought a house, it's worth less than I bought it for. At that point in time, have you lost anything? And the answer is no, because you haven't sold it yet. It's still a house. You still own as much house as you used to do. And if markets fall, you still own probably the same number of shares, the same number of units in a fund or whatever than you did before. They're just worth slightly less. But that decline is temporary. And if we can only just find that slot of time to remember that stuff, we might just push back. And that is all the difference it makes. It needs to make to stop you making an unwise decision and bailing out early. It's repetition, it's experience. It's listening to people like you guys and me, hopefully, over the longer term.
Yeah. I hope that people go through it early in their investing journey,
Yeah.
because I think the most damaging thing is to kind of be like miss it all, and then just before retirement you see a crash and you make a rash decision. I think you kind of got to get punched in the face once, haven't you, to know what it feels like.
I agree. Earlier the better. I mean, there's people who sort of got started in 2009. So, this glorious rise for however
and then
long.
COVID, and they
sure. Which, I mean, was, hopefully a once in a century event. But I mean, that was the sharpest and steepest market decline I've ever known.
But then one of the quickest recoveries.
Exactly,
and
right.
You could easily miss it, like
you could,
because it was so quick. It was over. It was end to end, like a month or two, wasn't it?
Ridiculous. Yeah. And whereas, I've walked with clients through 2007, 8, 9. March 2009, people forget there were still headlines in the newspapers saying there's 50% left to go, drops. From March 2009, markets were already down 40, 45, 50%. It's going to drop another 50%. So we're talking 3/4 of your wealth wiped out potentially. But of course, that ended up being the lowest point, which tells you should be very careful who you listen to.
Yeah.
Which I think is a key part of helping ourselves behave well, is guard our intake. I mean, it's never been worse than it is right now. Mm-hmm. But if you held your nerve in March 2009 and you didn't bail out and cut your losses, then you did very well.
I'd like to use a more recent example and kind of get your thoughts on it. In the budget the most recent budget, we had a lot of speculation leading into it, especially around things like capital gains and pensions. And we know that from the receipts that people made decisions pre-budget. Yeah. So they sold houses, they withdrew money from pensions because of the speculation. And then it was kind of, they shouldn't have done that, really, by the looks of it. It wasn't as bad as it was thought. I mean, there's elements of it that are worse, but how do you think people deal with that then, when they think that something's coming in that sense? Because it's different to a stock market drop. It's either is or isn't. For example, the stamp duty point of just after that budget, it's now more expensive.
Yes, it is. I mean, I was intentionally silent in the run-up to the budget, just saying I will not add to the weight of just guff around this stuff. We don't know anything. And of course, so much of it is coloured by our political tendencies, the way we might lean anyway, that, I had calls from clients, I read this morning, they're going to do this to inheritance tax. Where do you read that? Daily Mail. Okay, let's just stop a minute and think, okay, you've got a right-leaning paper talking about a left-leaning government. Yeah. Do you think that's going to be unbiased, really? And of course, and it's what Scott Adams, the creator of Dilbert, would call loser-think, right? It's too simplistic. Daily Mail says this. I've read the Daily Mail all my life, so it's probably going to happen. What should I do? Well, that might not be right. Why don't we stop for a minute and think, is that information even remotely going to be correct? It's certainly not unbiased. So, I didn't want to be any part of adding to that, but it's been the worst budget for that I've ever known. I think it's because of the length of time between it, or being announced and it actually happening. So, I think we're in the realms of sort of golden rules. It's like, obviously, for me as a regulated advisor, if I'd have advised a client to do something based on rumor, I'd be in a whole world of trouble. I mean, depending on which way it went, of course. But I mean, I won't gamble my clients' futures based on what I think might happen. And so a mantra for me is always, you can only plan for the regime that you know, right? You plan around the system you know. But again, who knows how long the changes that are made in the budget are going to be in place. 2015, pensions freedoms, changed everything for me and my clients. We spent 18 months changing stuff. A lot of that we might have to change again going forward, but that's okay because the clients have hopefully got 20, 30 years left to live. Mm-hmm. And so short-termism and the sort of recency bias, that sort of doing stuff based on what we've just heard about or what's just happened, I think is a danger and is incompatible with multi-decade wealth building.
There's nothing in business as important as trust. To be honest, my whole business is about trust. And that's why, if you're running a business, proving trust through your security programs like GDPR is as important as it gets. Vanta helps centralize program requirements and automate evidence collection for frameworks like SOC 2, ISO 27001 and more. So you save time and money and build customer trust. Plus with Vanta, you get continuous visibility into the state of your controls. Join more than 8,000 global companies like Flow Health, Synthesia and Alaka Bank, who trust Vanta to manage risk and prove security in real time. This is the new way to handle risk, governance, and compliance. And you can get $1,000 off Vanta when you visit vanta.com/makingmoney. There's a link in the description for you. I want to talk about your background a little bit. You mentioned it before, that you were raised in a religious setting.
Yeah.
How did that influence your view of finance in the world coming out of that? Would you say that you're out of that now?
Be careful what I say here, as I may be disinherited.
It's a hot topic. If I was talking about religion, my parents would be like, be careful what you're saying.
Yeah.
Look, I choose to take all the good stuff from it and have rejected a lot of the bad stuff, a lot of the bigotry, a lot of the small-mindedness, okay? But generally speaking, it was an overwhelmingly positive upbringing. My parents served other people tirelessly. So my house was continually filled with needy people. Which was, I perhaps might have, when I was younger, maybe resented that a little bit because my parents gave a lot of time to people other than us, but it didn't do me any harm, not really. And in fact, was an incredible model of service and giving, which I think is part of what makes for a whole rounded life, right? Not just about accumulation for ourselves, but about giving to others and spreading that around. So the sort of, financially speaking, mum and dad definitely went through phases of having more and less as my dad's role changed. So he was a pastor of a church, but not a sort of vicar in the C of E. I was raised in sort of evangelical churches. So he had a salary, but that might have risen and fallen. There were definitely times when we'd have a Chinese takeaway on a Sunday night and times when we didn't, right? And that's kind of how I was aware of it. I had zero money lessons from my parents. They would dispute this, but it's unequivocal. Money was a taboo subject in my house. I don't really know why. One day I'll ask my dad, but I probably won't get anywhere because he'll probably give me the same answer as he did my entire childhood, which was, that's none of your business, son.
Okay.
Right? But so money was a taboo subject. So they didn't teach me anything about it. My wife taught me more about money than anybody. She was extremely good with her financial controls. I was a financial train wreck when I left university, where she had a car and, a positive bank balance, days before student loans, of course, right? So for me, it was about people and service and about putting your assets to good use, however you define that. Right, and I don't think you need religion for that to be the case. There's plenty of non-religious people who are incredibly selfless and giving. But I tend to quite often come back to the three uses of money, which is to spend on, living well, whatever your definition of that is, to invest and save so you can spend it later, and to give it away. I don't really think there are any other uses of money than that. And of the three, giving is, I think, perhaps the highest calling of all, but it's the one that's the hardest.
Yeah.
But it's incredibly rewarding when it happens. So my mum and dad are not rich. My parents-in-law are sort of wealthier, but they're also very generous. But, both families have taught me a lot about putting assets, not just financial, to good use.
Because they didn't teach you about money, but you say that you carry a lot of the lessons from the religion, and this is the points around giving and stuff. But you've been through this transformation. How much do you think people can transform their understanding of finance from their upbringing? I
think there's no limit to it. I think the only limiting factor is any that we put on ourselves. And I think sometimes, you don't know that you're limited, though. And, so it's not that we've intentionally said, I'm not going to think any more about that, or I'm going to just sort of put a ceiling on it. It's just like, well, maybe that's all there is to know. Or so often I'll never be any good at this. That might be stuff we've heard from parents. There's so much damage can be done.
People say that about money all the time. I am bad with money. That you hear that all the time, don't you? Yeah. I'm really bad with money.
Yeah, and I hate that.
It's like a limiting belief.
Yeah, it is, but it's really powerful. It's almost certainly not true. Anybody can be good at this stuff, I think, unless there's real mitigating factors like disability or whatever, cognitive impairment. But I think I absolutely believe that the basics, the roots of good financial management are actually very simple. Mm-hmm. You can complicate it to the degree that you're interested in it, but anybody can do the basics, and so nobody needs to be bad with money.
Do you think like all these I don't know, rules we hear as a child. Like, for example, our producer Ruth was saying her father said, don't get credit cards, debt is bad, which is what my parents said, debt is bad. And things like, I'm not good at money, or I'm not good with money. It's true if you say it. And if you say, I'm great with money, it becomes true. So do you think all these things are like
affirmations?
There you go. Thank you.
Yeah, I think they can be. I think those, so, Ruth's dad's lesson, debt is bad. That's what I would call a reductionist thing, right? It's too simple. Right, because not all debt is bad.
Dave Ramsey kind of
good debt, bad debt.
Yeah.
So Dave Ramsey's
he's anti-debt.
He's totally anti-debt, but debt has its place as long as it's carefully managed. I think that it seems obvious to me, and I think it's too reductionist to say debt is bad. It's too simple. We should simplify everything to the degree that it's helpful, but not go any simpler than that. And so, if we try to oversimplify something such that it sort of paints us into a corner, and so we can never borrow to do anything, then that doesn't make any sense. That's unhelpful. So we need to sort of reduce it and simplify it to the point to which it's still helpful and enables us to do stuff. To answer your question, T, I'll try my best anyway. I think these things can be self-fulfilling. There's massive damage can be done by parents. I mean, they reckon that our sort of understanding or our messaging around money and even some of our behaviors are set by age 7.
Yeah.
I mean, that's terrifying. I remember picking my youngest daughter up. She spent a day with a friend, and I went to pick her up and went into the house where she was. And on the inside of the letterbox was this sort of big flowery picture, which said something like, great things will come through here. Checks, cash, promises of a brighter future will come through here. Right? So it's sort of an affirmation thing. And I thought, what an interesting lesson that my daughter's friend was learning, that we kind of have to wait for stuff to come to us. Whereas I've tried to teach my kids, look, the world is your oyster. There's never been more opportunity. It's tough out there. There's no doubt about that. But, so much of what we achieve and gain is down to our own effort and skill and learning and making mistakes and all that sort of stuff, rather than just waiting for it to happen. So we need to be careful with that messaging. I think they can be overcome. But again, we're back to the sort of thing, we can develop ourselves. We can learn to think and act better. We just have to choose to do so and understand how to do so.
So let's understand that a bit then. How does someone go about changing the way that they think about money?
Awareness, I think the first step to changing anything is awareness, right? So the fact that I can't breathe and tie my shoelaces at the same time makes me aware that I need to lose some weight, right? So I think if we start with awareness...
You just got a cold.
Yeah, well, that too. Yeah, I don't have a cold 365 days a year. So I'm aware it's impacting my life in a way. So if my finances are... broken, if I'm not in a good place, if I don't ever feel like I'm moving forward, awareness that that's a problem and awareness that I might be able to do something about it is the first step. It's got to be. And obviously then there's got to be some kind of commitment to develop. The great thing is there's never been more information, right? There's also a lot of bad information out there. So part of self-development is learning to sort of sift the wheat from the chaff and get the good stuff and the bad stuff. Not easy, but, with extended social circles and things like that, we can perhaps have other people as a filter. I listen to Damien Talks Money, so you should definitely listen to that. That's a great show. I learned a lot from that. Okay, cool. So that saves me looking at every finance podcast first, because somebody I trust.
Ask the person in your life who's got it together, the resources that they consume, totally. Maybe. Yeah.
I do think that goals, almost sort of makes me want to wash my mouth out talking a little bit about goals, but wanting to improve and maybe putting some kind of either number on that or some kind of definition on that can help drive things forward. So for me, if it's like I might want to achieve a certain weight, right, get down below 100 kilos, say, right, okay. But maybe it's, I want to get to a point where I'm not just dipping into my overdraft every month. Maybe I can get there by the end of the year. What do I need to do? So if we have some kind of goal with some kind of clarity, then that will help. It will help us drive change. It will keep us motivated, I think. And then there's all the stuff that we all talk about all the time, which is sort of commitment devices, so automation and things like that. So I know George Agan, who you had on recently, did some great stuff on this. Saving, even if it's a tiny amount to start with, saving automatically on payday. It's just, you don't even have to think about it then. It's something I can do automatically, and it removes the requirement for a decision to be made. I'm just going to do it. I make the decision once and it's done. I think our calendar is one of the most useful devices that we probably don't use enough. So if I decide I'm going to save 25 quid a month and I set it to go out on payday, what I do is I need to put a reminder in my calendar 3 months hence and increase it to 30 quid a month. Right? And then set another date for 3 months after that and make it 35 or 40. Because otherwise, we'll still be saving 25 quid a month in 3 years' time. So actually, if we can just force ourselves, I'm feeling motivated right now. I want to make this change. And so I'm going to pre-think, because maybe in 3 months I won't be motivated. I might be feeling a bit bad about stuff. So actually, I'm going to put a reminder in my diary. You decided 3 months ago that you want to increase your savings. So things like that. Helping ourselves, putting money maybe in accounts where there's a penalty if you take it out. Lifetime ISA is great for that, right? You get a benefit for going in and a penalty for coming out. So that might be a good device. It sort of forces you to make better decisions and is likely to put a barrier in place of you thinking, I'm just going to take that money out and blow it, right? You're less likely to do that if there's a penalty. I think we can benefit from sort of decision frameworks as well. So I talk about this quite a lot. So if we know ourselves, which is actually probably the most difficult thing in all of this, because it's really hard to be honest with ourselves. But if we know what might trigger us to make a bad decision, maybe we think back to a bad decision, a decision we regret in the past, and actively think about what led to that decision. What can I put in place now to avoid making that decision? So I remember speaking to Greg Davis, who's Oxford Risk. He's a behavioral finance genius. And he said, he spent his days surrounded by market screens, right? As they're all turning red, it's very easy to think, oh God, I'm just going to bail or whatever. But he actually just said, I will never make an investing decision on a weekday when I'm surrounded by those screens. I will only make them on a Sunday morning with a cup of coffee when I've had time to breathe, relax. And it's a kind of a decision framework. I will only make a decision about my investments when I'm not surrounded by a load of negative triggers. He's pre-thought that and put in place a framework for making a decision.
It's a hard rule.
It's a hard rule.
So it has to, it's only then.
You talk about that quite a lot, which is good.
Yeah.
So you're putting those rules in place for yourself. Those are not limiting factors. Well, they are, but they're a positive limitation, which I think is smart. So things like that. Don't make a financial decision when you're, half a bottle of wine in, right? Or it's Friday night and you're knackered and you've had a crap week. Those are not times to be making decisions about your future. Do it when you're feeling rested and you haven't had a Barney with the wife or whatever. Do you know what I mean? Do it when you're in a good frame of mind. These are just things to think about in advance.
What if you're in a very good mood, like you're in overly good mood, elated? I wouldn't say drunk,
but you're
buying
just crypto.
Yeah, you're just
right.
I've got two examples. So one, I'm a Chelsea fan, so I used to go to all the football games, and me and my friend Ollie, we go watch a game, and we're like, okay, let's put like 50 quid on Chelsea to win. Chelsea would win, and we're like, yeah, we won, we made some money. And then afterwards, we're feeling great. We're like, oh, let's bet on Liverpool. And then they went, by 7 p.m. you're betting on Turkish League 15 football. And it's like, you don't even know who any of the players are, but because you had a win, you're feeling great, you had a drink, you're like, yeah. And the next thing you wake up, you're like, how did I lose like 500 quid yesterday when I started by winning 50 quid?
Exactly.
And then the other day, the crypto market was pumping. I'm well diversified now, but the crypto market was pumping, and the old me, pre-podcast, would be like, I don't want to miss out. Fear of missing out, FOMO, and desire to gain.
Yes.
I want to, so those are my
emotions.
Powerful emotions. You want to make money or you don't want to miss out. But when you're in a good mood or you're very happy, how do you is it a bad idea to invest then, or to make a financial decision?
It can be. When we're talking about emotions, we do very often. We slip into talking about negative stuff. Oh, market's tanked. I'm feeling awful. I don't want to lose anymore. I'm going to bail. But actually, you're dead right, T. As things are going great, there's as much danger potentially in that. So it's awareness of that, like anything else. But yeah, definitely something to be aware of.
People take more risks when they've had a gain. Like you say about casinos, but even in like the Dunning-Kruger effect, this kind of false confidence that people get.
Yes.
If fear is the most dangerous emotion, overconfidence is probably right there, isn't it?
100%. I mean, I occasionally will get an email from somebody maybe wanting to work with us, and they're like, oh yeah, I've built this portfolio to that, and you sort of dig in a little bit, and it's like, well, I mean, honestly, a monkey could have made money in the time scale that you've been investing, right? So you're not a genius, you're not all that. And again, I think humility, perhaps something I've learned from my upbringing, a little bit of humility can go a long way. You think, actually, none of us really have any idea about what we're doing. There's so much that is down to timing and good fortune. So we need to just take a little bit of a chill pill and say, I got lucky there, so I'm not going to push it.
Yeah, and like the example of global markets or the S&P have done so well over the last few years, and then everyone starts trading because they're like, well, I figured out that, so I must be able to,
Yeah, one-way ticket, innit?
Yeah, exactly.
Yeah, I'll put more money in.
Do you think being passively invested in a global index fund is diversified enough, or do you think we should be introducing other asset classes?
For most people, yes. In investing in a global equity fund, the makeup of that fund, the constituents of that fund are going to change anyway. But what you're buying is human endeavor. You're buying into sort of capitalism as a system, essentially. For all its flaws, it's still the best system we've come up with to build sort of corporate and communal wealth. And because you're buying, what would a global index fund? 25,000 stocks? No, less than that.
Maybe it depends on the index, but like a VWRL maybe 3 to 4, but you can get some with 6 to 8,000.
Okay,
right. If you include small caps, it gets like 8,000.
That's probably diversified enough for most people.
And you're getting gold companies in there.
Yes,
you're getting
exactly.
miners. You're getting commodities. You are getting every type of asset, really.
Yeah, you are.
Exposed
That's often
to-
the argument given for S&P investing as well, because it's American markets, whatever it is, 65% of the global market. You're getting global sort of exposure through American companies. I'd still prefer personally to go full global, but yeah, I think that's enough for most people, man. You complicate it to the degree that you want to, but for the vast majority of people, that's fine. I am 100% global equity invested.
There you go, and that's good because you're a man of experience.
I've tried other stuff. I get bored of it, and actually, this is the stuff that will work consistently.
Yeah, and then you don't like. I find that because the American decision, especially, you are making a decision. If you say, I'm only buying America, you're making a decision. And then I think that complicates it if things go wrong, which they might. America might have another lost decade like it did between 2000 and whatever. And then you're sat there going, oh God, should I be buying France or whatever? If you buy the world, well, I own it all. Like there's no decision. There's no decision to make. Like I've got a bit of everything.
Yeah.
China does well one year, great. I've got a little bit of that,
And as the world changes, as I think it's inevitably going to do over the coming decades, as the world increasingly moves eastern, wealth moves eastern, all that sort of stuff, you will capture that. So you don't have to think about it.
Yeah.
I'm all for that.
And if America continues to dominate, you capture that as well.
Exactly right.
So.
It's the sort of ultimate lazy investment.
How do you think that rationalizes with the human brain that the simplest, easiest thing to do is the best? Because I think that's complete odds at how we think about life.
It is. We hold complexity as a badge of honor.
Yeah.
Where it rarely is. I think usually the people that gain from complexity are the professional advisors, right? The number of reports I've seen written by advisors for client situations, I just think the only people this is serving is the advisor. There's no need for this level of complexity. And I think that's a fairly good rule to live by. It's like, who is benefiting from this complexity? Is it the lawyers? Is it the accountants? Is it the financial advisor? It's almost certainly not you. Complexity usually adds cost. It reduces engagement. So you're less likely to be engaged with a complex portfolio than you are with a simple one. And those are fundamental negatives. So simplicity wins every time for me.
You know Romin from Pensioncraft. I know you know
A lot of time for Romin.
Yeah, he was from a traditional background in the sense of he worked in the city, he worked in banks. He was a teacher of investment bankers, was his training almost.
Brain the size of a planet.
Exactly, but he admitted that he came out of that space, started a YouTube channel, had his portfolio up, and someone went, why don't you just buy a global index? Because he had like this kind of all-weather, back-tested, 20-fund portfolio. And he looked at it and he was like, yeah, why don't I just have a global index? Why am I recreating a global index inside of a portfolio? You
It's
know,
only going to cost you more to try and do it. You know, I take credit for Romin.
You take credit for him.
I met Romin.
I said you are
This is
our
why
father.
you're the godfather.
You are the father.
The OG
We're all
of
your
this.
sons.
Yeah.
We are all your sons.
I'm your grandchild. He's your son, I'm your grandchild. So don't forget about the kids when you're
He's third generation living off the teat.
suck your
He don't work hard enough.
It's a little bit tongue-in-cheek, but I ran into Romin, met him for the first time at a conference in 2017. And he said to me, I'm thinking, he just left his job, and I think he was in a bit of trouble with his wife, right? Because I think it was a big thing for him. Because
it's his ex-wife.
Yes, sorry. Thank you.
Yeah.
Important clarification.
There's a lot of trouble.
Oh, okay. Yeah. That didn't end well, did it? But he said, I'm thinking of doing some stuff on Vimeo and charging, people to watch it. I said, you need to put it all for free on YouTube.
Boom. Yeah, because who loses Vimeo? Maybe people do, but
I haven't used it for like 7 years.
I take a general amount of credit, but I think Romin's a genius.
No, he is amazing, and another calming voice within the space. And
I don't think there's anybody better than him at simplifying and making understandable investment principles and theory and practice. I think he's a very clever guy.
Yeah. There's a problem that a lot of business owners face. I was one of them until recently. What do you do with the money that's sitting in your company? That excess money that you don't need to use to operate, but you don't want to rip it all out and just get taxed into oblivion. If it just sits there, inflation destroys the real value of it. But a lot of small companies, including sole traders, don't do anything with the cash in their business accounts. This is why I'm happy that we're partnering with Tide. They offer an instant access saver account where new customers can get 4.07% AER variable on unlimited deposits until at least the 31st of March 2025. I use a Tide account, and I even store the money that I need for my VAT in there just to generate a bit of interest while I'm waiting to pay the bill. If you're interested in putting your money in the business to work, head to tide.co/savings. There's a link in the description for you. For full offer T's and C's and Tide's terms, visit tide.co/terms. Variable rates are correct as of the 7th of November 2024. You talked about a second ago the influence of media and trying to switch off from those things when things are going bad and people making rash decisions. And we know that when markets drop, they're dropping because people are selling. Mm-hmm. How should people think about decisions in those times?
It's probably perhaps the most difficult thing in the world that we live in, where we're just bombarded with this messaging 24/7. It's really hard to switch it off. Really, I think it's some kind of acknowledgement of the fact that we're in a world which is designed to inflate everything, and our reactions very often will be amplified as a result. So start by understanding that. I think also understand that whatever you read, hear, watch is going to have its own agenda, right? So that's abstract objective thinking, but it's really hard in the moment to remember that stuff. I think more than anything, remembering that, God willing, we're going to live a long time, and that in the context of a multi-decade investing career, 50 years potentially. If you're 30 now, you're probably going to live to 90, 60 years, right? Is what's happening right now going to matter a jot in that timescale? And the answer is just an unequivocal no. And, you've got time to make good. Even if you make a bad decision, there's very few decisions which are irreversible or you can't claw back from, I think, in finance. It might set you back a little bit, but you're unlikely, I think, unless you're putting, going all in, red or black, putting your house and everything on the line. That would be a risky decision. But actually, the world is much more nuanced than that. And the context of longevity and the time that we're going to be investing over, I think, is a real powerful factor. even with my retired clients, they'll say, "Wow, I don't want my portfolio to fall anymore. I'm 80 now. I haven't got time for it to come back." I'm like, "But this is family money, right? You're probably not gonna spend it all before you die, and so we're actually investing for your kids and your grandchildren, and so the investment timeline gets even longer."
Yeah, generational.
And we must think of money like that. It's just one asset, and if we're going to leave a really good legacy. I spend a lot of time encouraging clients to think multi-generationally rather than just their own lifespan. But even if we do only think of our own lifespan, it's still multiple decades, hopefully. And that should be enough.
Your motive is to think about your whole life and your kids' life and potentially beyond. The motive of the media and even people like us is to make a video or a piece of content for that week.
Yeah, get the clicks.
And you need to understand that. And I think people like yourself and hopefully me are a bit more balanced and have a long-term view. But CNBC just thinks, what are we going to do today that's going to keep people watching? Exactly, and the answer is invariably make it seem like it's crappier than it is.
Sensationalist.
Yeah, because that's what people click on, and they figured that out. The clickbait was invented by them, right? It's not new to YouTube. The clickbait came from traditional media.
You wouldn't take advice from somebody who didn't have your best interest in mind, and so you ought not to make decisions based on a media that cares nothing about you and is entirely misaligned with your long-term outlook. So you're dead right, Demo. It's all they want is today's clicks, today's eyeballs. What you want is wealth for the rest of your life.
But when we grew up, when we were growing up, wouldn't you say like you would trust what was in the newspaper? Kind of. I don't know. Maybe it's just like 'cause I'm getting older. But like when I was younger, I think like I see my dad reading the Financial Times or reading like the Telegraph. I'd be like, oh, whatever it says in there is the truth. And then as you get older, you're kind of like, oh, people have their own agendas. But I still think in the back of my mind, like you kind of,
me too.
If they put it in the media, you're like, oh. They put it on BBC. It's true. They put it
definitely true.
Yeah, it's definitely true. They put it in the Telegraph. It's true. Like
we're fine here in the UK. American media's terrible.
Yeah, that's right.
It's nonsense. They're just as biased in the UK.
They're owned by the same bloke. A lot of it.
That's true. Yeah. Must remember that. Yeah, for sure. It's again that's part of our upbringing, isn't it? That sort of thing that we have to develop, and as we grow and grow up, we start to question that stuff, and we should question it. We should question everybody's motivation. It's a fine line between cynicism and questioning. I think cynicism is taking things too far, but we should question everything.
I had an experience of this in terms of a market downturn and how I reacted and how I had to manage my own emotions. And it speaks to what you said about feeling good. So in the COVID crash, I was buying a buy-to-let property. I was going to buy one. And then the market dipped 20% basically instantly. And I knew that this was an opportunity to make some money. And we were going into lockdowns and stuff. So the property thing had a big question mark over it. So I cancelled the purchase of the property, had my deposit, and the temptation was just to throw the whole lot in. But I was in a group of like-minded kind of investors, and everyone was talking about, how are we going to buy this dip? Because that's what we wanted to do. And we just all kind of talked to each other and came to think of like, right, let's just buy once a week on a Sunday, or like, place the order on the Sunday and then it'll just execute on the Monday. And then that's it. Because, I got to say 20, 30K and I just want to bang it all in right now. But then, the market could drop another 50%, could drop another whatever. We don't know. And that restraint that we had to show, it was really hard. I just wanted to get it in. Yeah. But actually it meant that I went all the way down. I hit the bottom on one day. Right? I can say I timed the market perfectly. I did 20 purchases, over the course of a few weeks. But, that was like, that community gave me that system, gave me that resilience or that kind of, we all were in it together and we were all like, today's the day we buy, come on.
Yeah, well, that helps, doesn't it? Yeah. So if you've got people, in similar sort of circumstances to you, then definitely sort of groupthink can be helpful in that sort of situation. I get new investors ask me, should I go in as a lump sum? Or should I drip it in? Or quite frequently. I think if you look historically, in the vast majority of cases, you'd be better putting it all in one go.
Yeah, because the market trends upwards more than it goes down.
Yeah, right. Yeah. But, so I tend to say, look, if you want to drip it in, that's fine. As long as you understand that it's more of a sort of emotional, psychological crush than it is a financial one. Because you'll either wish you put it all in on day one, or you'll be glad you didn't. That's binary, right? You'll either you'll either be better off or worse off as a result of whichever decision you make. But if it makes you feel better, putting it in and dripping it in over time, that's reason enough to do it, I think.
Yeah.
If it's less likely to lead to regret, lost sleep, then do it. You might be worse off, you might be better off. You can't control that, though.
What people don't realise who pay in every month from their wages is their lump sum investing. They're not dollar cost averaging. They're putting every bit of money that they've got to invest into the market at once.
Nice.
So, like people think, oh, I dollar cost average through my wages. No, it's all going in. A drip feed would be, I've got 100K here. Do I slap it in or do I go $1,000 a month? And that's a very different kind of mental joust, isn't it?
Yeah, it is.
Yeah.
I always say, look, never more than 6 months. Else there's too much opportunity to question it. It's like if you got a lump sum of money, don't put it in over more than 6 months. It's just like,
and the inflation is doing a number on it,
right?
and stuff.
So just either get it in and just suck it up, which is easy for me to say, but obviously not very easy to do sometimes. Or just say, look, I'm going to do it and I'm going to set the payments to go automatically, and I just won't think about it.
And what you said as well about over 30 years, is it really going to matter that the market dropped 2% on one day, one random Tuesday?
Won't.
Yeah, no, you'll look at it and go, oh God, I'm glad I bought then. I wish I put more in. Not that, there was, you get your Black Mondays, which are big events, but even those kind of, they all fade away on the long timeline.
They do. When you look at the map over, look at the chart over a 50-year horizon, those are minor blips, even though they were horrific at the time.
I think, was it Richard Coffin? Someone on the podcast said that time in the market beats timing the market.
I think he was quoting someone
else.
Yeah. Like a Warren Buffett or something.
Yeah, but the longer you're in the market, it's better than like, let me get the right day. It's better to just be in it from the start of the longer time.
Yeah. And again, it's an understanding of volatility and risk. We tend to think of risk as an all or nothing thing. It just isn't. The biggest risk by far is, I think, again, George mentioned this when he was on the show, is that, you're going to miss out on growth. You're going to be able to live less of a full life because you didn't invest, because you were worried about short-term volatility. Volatility is not risk. They're two entirely different things. Volatility is the price of entry as an investor. You've just got to accept it. You can temper it to a point, but it's working for you.
Yeah, the biggest risk of investing is not investing.
100%.
Yeah. You spoke before about automation and how automation can lead people into investing habits. But I also saw from the briefing that you were kind of cautious or critical about its involvement as well and how it can limit people. So could we just explore that?
Yeah, it can. I mean, automation it removes decision making, or you kind of pre-make the decision, and the decision is to set up the automation, then you don't have to think about it again. It's just can be, I think, a fine line between automation and kind of abdication, because if you automate fully.
I haven't hit that yet. Abdication. I know that's from like when you abdicate the throne.
It is.
Yeah, so I don't know what it is in finance, but I know I'm a king, so
You give up responsibility for.
Yeah. Okay.
Is how I would define that.
You know what the buzzer is, because you didn't crap yourself when you hit it.
No, I know what the buzzer is.
I'm
a listener, man. I know what the buzzer is for. So give up responsibility for. So automation is great if it helps you make good decisions, but what you don't want to do is then forget about that. There still needs to be some intentionality. So I talk a lot about kind of putting in place some kind of review program where you look at everything same day every year. There's a bit of a checklist that I produce. It's like, just think about these things. And again, use your calendar, put it in the calendar and review your automation. So I don't think it's certainly not a bad thing. It's just, we need to keep it in its place, like everything.
Go on.
Sorry, I was just going to say, why do you need to review the automation? Why can't you just leave it? And like, if it's something like investing every month, why can't you just leave it?
Review the amount. Okay. Maybe if your understanding is developed or whatever, maybe review how the regular investment is being invested, maybe the split of funds you're buying or whatever. So those things, not the automation itself, just
the
how
details.
It's being,
Is that the checklist? Have you got like what's on that checklist? You say, do you know roughly what's on that checklist?
You want me to recall that from memory? Well,
no pressure.
So it's things like savings rates. So can I increase my savings? I tend to suggest there is real power in small increments made regularly. Start at a lower amount and push it and push it and push it until it feels slightly uncomfortable. Review, obviously, if you've had a pay rise, so your savings rate as a proportion of what your income is, maybe that's worth reviewing. Can you push that any further? Even am I living properly? Actually, am I saving too much? Am I actually unhappy? Because, you should definitely live in the present as well. Has my need for insurance changed? So, have I borrowed more on my mortgage? Do I need to tweak my life insurance? Has my job or my salary changed significantly? Do I need to look at my income protection? Makeup of your portfolio. So has it fallen out of whack? Do I need to rebalance? If you are, maybe an 80-20 investor, so 80% equities, 20% bonds or whatever, or 60-40 or whatever, has that fallen out of sync? Do I need to rebalance? So it's just it's almost like, financial sort of donkey work. It's the simple stuff, but it's worth looking at regularly.
Is having an advisor a form of automation?
It's a form of delegation, but potentially. Part of what we would do is remind people to do the obvious things every year. And often we'll set up those automations for them. So, bed and ISA, if they got money in a GIA, shift it into ISAs every year, likewise into pensions. Doing those things, reviewing the sort of investment makeup. So, it is. I've built a career on telling people they don't need to see a financial advisor.
Yeah, this is
which is
a
deep irony.
Yeah.
Well, obviously I am one, and yet I'm busier than ever. So go figure, right? But I'm utterly convinced that people can do this themselves, but plenty of people don't have the time or the inclination. So that's why I have a job.
And is it a money thing, or is it like a certain type of person kind of thing? What's your experience in terms of who are the people that should be speaking to a financial advisor?
Look, 98% of people just need a pension and an ISA global equity fund. And it gets complicated when you approach retirement. But wealth building is the simpler phase, I think. So we add real value, I think, when you've got people with 9 different pension plans. And, DB schemes paying out, defined benefit pension schemes before you hit the buzzer.
I was about to.
Yeah, right. Defined benefit pension schemes paying out at different times, and understanding the different threads of, when incomes are going to pay out, when expenditure's going to go out, different events, inflation, holding all that stuff together, particularly at the transition point into retirement, is basically where we add the most value. So I think an advisor can add value for anybody at retirement, unless your circumstances are very simple. But we tend to deal with people who are at that point, but also people who maybe have got sort of like complexity. So maybe there's trust funds involved, or maybe they've got money in multiple jurisdictions, or maybe they're very high earners, and so their obvious options are limited. They're fully tapered on their pension, so they can't put much away. So it's the sort of 2% that need to think a little bit outside the basics, really, that we tend to serve. But even that, most people can do if they want to.
Yeah, I think if people understood that better, that really financial advisors are for the complex parts of planning and the rest is simple, because the messaging to the world is a bit like, go see a financial advisor. But what you're saying is, no, the accumulation phase, really it should be, it's relatively simple if you just do these few steps.
Yeah. Do them consistently and do them well, and keep things under review. And there's so much great information to help you do that. So yes, it's mostly... It's not even really about level of wealth. It's about complexity of situation, really. So I've had kids who have lost parents who have trust money. Well, there's a world of, it's not actually that complex, but there's a world of psychology behind that. You've got kids who are reaching age 18. Well, you want them to understand that money and be able to use it without loading them up with a load of guilt, because, they lost a parent to get that money. Right, that sucks. So, I've had to walk through that. I believe the vast majority, if I had to put a number on it, 90% of an advisor's value is in the behavioral stuff. It's keeping people behaviorally on track. Yes, we understand the technical stuff, the tax stuff and all that, but most of it is keeping people in their seats and helping them to make good decisions. So to that degree, it's not necessarily an automation, but we are a coach.
I pay a PT to shout at me in the gym.
Yeah.
And I know exactly what I need to do. I know what I need to lift. I know what I need to eat. But in my older age now, I know
older age.
Yeah. But I'm just in my 20s, I was highly motivated with that. And now I find in my mid-30s, I find it a lot more difficult to prioritise and carve out that time. But if I've paid a guy for an hour, I'm not letting him down. Do you know what I mean? Sure. And I go. And I know that my means allow me to do that. And I know not everyone can do that. But it's a similar kind of...
Well, that's a form of commitment device, isn't it? Yeah, you're paying, guy. It's like those things in it where you write a check to the sort of the Trump campaign if you don't like do your reps in the gym or whatever, and somebody else has got it.
I've got one of those this year. Right? If I don't make a certain amount of videos, I have to post £200 in cash to Man United, and I haven't. I'm not going to hit the videos. So I found like the lovely receptionist that's worked there for 40 years, and she's just going to get £200 in cash sent to her. She probably think it's got anthrax on it or something like that.
From a City fan as well.
Yeah, right. Yeah, but like, thanks for the work you do. Here's 200 quid. But yeah, I said it at the start of the year, and I'm not going to hit the goal, but
No, that's gotta hurt, man.
Yeah, it does, but it's also, I set the bar. I've done more than I thought I would, and the business has done great. And I might not have made as many main channel videos, but the podcast is doing great. We've got other channels, blah blah blah. So
sounds like a rationalisation, that, mate.
Yeah. I'm trying to talk to myself.
You still got to send the 200 quid.
Yeah, I'm gonna send her the 200
accountability. Quid. You just mentioned about like kids with trusts, and unfortunately their parents passed away. Do you find different money behaviors with people who like grew up with lots of money compared to people who didn't, or is it kind of humans are just the same? We're just not good with financial decisions overall.
Yeah, great question. More the latter than the former. I've dealt with like 2 lottery winners over my 27-year career. The vast majority of people are self-made. So I wouldn't say any better or worse, just maybe a different view of it. So we've got 2 families that I can think of who were on the 4th generation as clients. So, great granddad was a client, now passed away. Grandparents, still clients, parents, and now I've got sort of 25-year-old kids. Oh. We're a 50-year-old company, so, that kind of consistency has helped. So it's interesting to see different behaviors, different views of the different generations. The grandparents think that the grandchildren don't work hard enough. Right.
I think that's pretty universal.
I know, it's just nonsense.
Back in my day.
It's reductionist thinking. I don't like it. And I will challenge them on it if it comes to it. They don't want to give them too much in case they have it too easy. It's like, actually, it's really hard to be a 25-year-old at the minute, right?
They inherit some money as well by the sounds of it.
Exactly right.
It's a great granddad, the one that's got the claim and say, I work the hardest.
Particularly if they're farmers. It's like, okay, did the 150 acres just, magic out of nowhere? No, you inherited that. You've had to work it. But so, yes, we've all had a leg up to some degree, many of us anyway. So I'd say it's just different. It's not better or worse, but it's endlessly fascinating.
How about the lottery winners? What was their psychology like coming into it? Were they buzzing or were they scared?
Minor lottery winners, I should say, £1 million in both cases. So it's still a lot of money.
It's one of them though, where it's not. I have a friend who was in a car accident and he's fine now, but it was he got hit at 80 miles an hour, driver side on in a 30. Yeah. So the guy was going 80 miles an hour in a 30, slammed into the side of him, destroyed his car and then knocked a house over.
Wow.
He was rebuilt.
Imagine.
Yeah, he's fine now. Who knows long term, but he got a chunk of money. But it's like, he lost his business. That's why he did well. But it's enough money for people to go, wow, but it's not enough money to stop at 30 odd. Yeah. Do you know what I mean? And that's like £1 million kind of that number. I mean, you could spend that on a house, couldn't you?
You could, yeah. So, I mean, one case I'm thinking, literally, this couple won the pools. Right? Remember when the pools was the thing?
Yeah.
Pools is? Right. So they won the pools. They won a reasonable sum on that, a couple $100,000, I think. And then 6 weeks later, I kid you not, they won a scratch card for £1 million.
Why are they still playing gambling? They're going to gamble it all away.
2 months after that, he died.
No.
So, man, you think, and these people were best
song.
Yeah, yeah, exactly. Yes, isn't it ironic?
Yeah, right? Yeah.
So they were state pensions only. They had nothing. They had their own home, but they were living on state pensions only. Suddenly she's a millionaire, but now her life partner's gone. Oh. There's just so much to unpack. The money's irrelevant in the grand scheme of that sort of thing. I've seen far too many people work like dogs, retire and die within 6 months.
Don't say that.
And so I'm sitting.
This is why I encourage Damien to come on holiday with me and blow all his money.
But on you.
Yeah, on me.
Come on,
We're going back to Oktoberfest. Let's go.
Your money.
I've seen it happen too often, and I've seen these widows in these fantastic houses that they've worked to build and kit out, and it's just beautiful, and they're rattling around in there. I've got a lady who's got a property in Portugal. She never goes because she's got nobody to go with. And because they were just all in on each other, she doesn't really have a circle of friends. And it just puts money in its place, man, you know? And so that's why I love what I do, because I very often get to challenge that in clients. It just doesn't matter. The stuff you're talking about, you know, Mr. and Mrs. Client, about, you know, whether we should invest this way or whether you want to buy that extra property. It's like, for God's sake, you know, why don't you help your kids out? And let's build most of my clients, they've got enough, right? So I spend a lot of time talking to them about giving, which was circle back to that. Because money's not that important. It's a means to an end, never an end in itself. At the point at which money becomes so important to us that it becomes all-consuming, then it's overreached, and we need to get perspective.
Making money, Damien talks money. Financial.
Meaningful money.
It's I've overreached a little bit. Just a switch.
Look, it's important, right? We need it to live and eat and survive and all that sort of stuff, but it's not the be-all and end-all.
Who are the happiest of your clients?
The ones with great relationships with their family.
Yeah, makes sense.
No doubt. The ones who... I've got one family, they live next door to their daughter and son-in-law and 2 grandkids. And the kids are in there all the time. They sort of gently complain about it, you know, because I'll be in there chatting to him. Grandson will walk in, not say a word to him, open the fridge, get a drink, and then go out again. So that was George.
That was my grandparents' house.
You know
yeah,
I mean?
Great
but they
times.
love it, really.
Yeah.
And they absolutely love it. So I think it's ones who have some kind of purpose, and that purpose can be anything. And the freedom that money gives them to pursue that purpose, whether it's time with family, whether it's volunteering at the RNLI or at the cancer shop or whatever, or a church. I've got millionaire clients who do debt counselling, you know, help with a debt counselling charity, and that's all they talk about. Those are the happiest. Yeah.
Do you think a lot of people, when you talk to them about you've made all this money or you've got this money for retirement, give it to your kids, do you find like the majority of people are like, oh yeah, that's a good idea? Or do you find like a lot of people are like, forget them, I worked hard for it, this is my money? What's the percentage?
Yeah, more of that.
Is it more of the
definitely.
latter? Yeah.
Sometimes
Yeah,
I know,
it's a
come on.
shame for you, innit? You're thinking like, what are my chances here?
Yeah, you think that's weird? My parents are in law are clients, right? So try having a
really?
try
Give
having a
some money
gifting
to the
decision.
kids.
Yeah, try having a gifting conversation with your mother-in-law.
That's so good.
On a purely objective basis, you might want to give your daughter my wife.
Happens to be my wife.
yeah, but that's irrelevant. There's resistance. That's a generational thing. But again, with some sort of gentle encouragement, people come to it in their own time. I worked on one family for 15 years. She was always up for giving, and they've done little bits. But he was vehemently against it, not giving him it. He's going to have it all when we die. I mean, they don't even spend any of their capital. They live within their income, this couple. And I've finally beaten him down. And now we're starting to make some serious gifts. But sometimes it just takes time.
I think it's that thing of, you know, get the benefit in terms of be the legend at the table, you know, because you want to see their eyes when they get that, and you want to see the impact it is in their life. And you want to go to Christmas dinner that year and be like, I'm the man.
Yep.
You've all just like been sorted out because of me. It's like
exactly.
that's happiness, right?
Yeah, it is. Giving with warm hands is far better than giving with cold hands after you've died. Yeah, for
That's
sure.
a lovely way.
There's joy in it.
I like that, because my grandparents used to take all of the grandkids on like a cruise. So there'd be like 20 of us. We got a big family, and there'll be like 20, all the kids running around on the cruise, like me and my cousins, all going to the older ones going to the club on the boat, the younger ones going to like playgroup, and my parents there, my uncles there, and like those memories you got forever. But like once they're gone, it's not quite the same. Oh, your granddad gave you 10 grand. It's like, well, I would rather have gone on the cruise with my whole family.
For sure.
But
the joy that would have given them worth infinitely more.
And they loved
than,
it. Yeah, you could see in their eyes every time they saw their grandkids, they were so happy, and like
makes them happier than a zero on a bank statement. Right?
Definitely.
Yeah, what is the best piece of behavioural or just general financial advice you've ever been given?
I've ever been given.
Yeah.
Okay. Man alive. My first boss as an IFA, I had a couple of Tide advisor jobs. He said for him, his company, right, his sort of day job, if you like, was his cash cow. That's what made him the money. He took that money and bought assets with it. And that's lived with me ever since. So, your main asset is your ability to earn an income. That's why income protection insurance is so important. Take that away, really, you've got nothing to build with. You're entirely dependent on the state. So take that income and buy stuff with it that means you are less dependent on that income. That's ultimately, I think, the best advice I've ever been given. So buy, your global equity fund, buy property, if that's what you want to do. Buy stuff that will replace your need to earn an income. Buy assets.
Yeah. So for me, as context, my uncle is like one of my heroes, and one of his friends from university became very successful, owned one of the biggest funeral companies in the UK. And I was at a party once and we were talking, and my uncle was telling me about, I was like desperate for success, like desperate. I was like almost like angry at myself for not knowing what to do with my life. And we've got some background noise. Someone's polishing metal outside by the sounds of it. Yeah. I was almost angry at myself for not knowing what to do. And Paddy said to me one time that throughout life, you'll have a few opportunities to make a lot of money. You've just got to be ready when they go by you to do them. So if you don't know what to do, just build up, investments and savings. So when that thing comes in front of you, you can pounce on it, because most people can't when they happen. And that's what happened. I did that for 10 years. YouTube happened. I quit my full-time job because I had savings and investments, and that was my opportunity.
Great advice.
So for me, if you don't know what to do with your life, just save some money up, because something will come along and you can jump on it.
Exactly. It's freedom. It's power. It's opportunity.
It's just choice, isn't it? The ability to choose to. And I think a lot of people probably see things come along and go, oh no, it's not the right time. And then 5 years down the line, they go, oh, I could have done that. And it's like, well, if you're not positioned correctly for it, you can't.
Is that not the definition of wealth, or freedom and ability to choose?
I think
take opportunity of things.
Yeah.
So definitely great advice.
I would say kind of a little bit piggybacking on yours.
He does this a lot.
You just listen to the good minds and make it a little bit better. Remix.
Pull it back.
We talk a lot on the podcast about like you said, your job being the most important thing you have. That's how you make your money. That's like the biggest investment, investing in yourself.
Yes.
Damo said, like, whether it's YouTube channel, invest in yourself, or your main job, like you said. So for me, we did an episode on how to get a raise. And one of the points we talked about is, like, you say, this is what I do if I want to get a raise, to your manager. If I do this, will I get the raise? And also you can just change like jobs, and then you can use when you apply for the new job, you can go for higher salary because you've got experience in different areas. So it's kind of like moving sideways into like a different company. And then I would say, if we're talking real finance, investing in a global index fund, I think that's been a game changer for me.
Right.
Yeah, I thought you were going to end it with like buy Cardano or something like this. I was just waiting.
Buy more Bitcoin.
Yeah, I was just waiting for your degeneracy to feed through.
I'm evolving. I still have a little bit of degeneracy, but I'm evolving.
Yeah. And then one more question for you. If there was something that you would want a listener to take away from the conversation today, what would it be?
Two things. Am I allowed to?
Yeah. You can have as many as you want, honestly.
Oh, thank you.
We're
Very
all your
kind.
sons. I'm going to keep saying it until even Romin.
I'm feeling I'm pretty sure Robin's older than me.
Yeah.
I'm feeling older as the conversation goes on, but I'm fine with it. Simplify, right? It's a core message of mine. We do it for clients. It's one of our sort of core principles as a company at Jackson's, my financial advice practice. Simplification. It reduces costs, it improves engagement. You're more likely to be on board with your financial future if you simplify. Too many people end up with 9 pensions because they change jobs and they leave the pension where it was. It's a matter of less than an hour's work each time to get the information. It's probably a quarter of an hour's work, and arrange a transfer into your SIP on HL or wherever, right? So just simplify at all costs. And I suppose the final thing I want to kind of impress on people is work on how you think. Work on your capacity as a human to engage your mind and not be so reactive. So, you mentioned right at the start, Demo, about the stoicism stuff, being the best version of yourself. I mean, I love all that stuff, so I definitely encourage people to read that. I've got 2 brilliant books on thinking. One is called Loser Think by Scott Adams. So he's the creator of the Dilbert comic. Yeah. You remember Dilbert? Oh. But he's a political commentator and also it's a real sharp mind. Loser Think. I just love that whole idea. So how to avoid thinking like a loser, basically. But the best book I've read recently is called Clear Thinking by Shane Parrish. Shane Parrish is the creator of a blog called Farnham Street.
I signed up to it after.
fs.blog. Yeah. It's my favourite site on the internet. I've been a subscriber for ages. Even just their free Sunday brain food email is just gold every single week. So Clear Thinking is his kind of condensed version. He's also got a 4-volume set on mental models.
He's got a Substack, he's got a newsletter, so whatever you like, he's got something.
Yeah, he's got it, and he's great. Dan Crosby's got a good book on behavioural investing. The Behavioural Investor is called. The first half of it particularly is good. But that's sort of finance specific. But I think if we can get better at thinking, realise that we have almost limitless power to change our mindset, the way we think, the way we react, the way we make decisions, rather than just saying, well, I'm 25, I'm done now. I'm basically fully functioning as an adult. I've never been more aware on the threshold of my 50th birthday in February of just how much I've still got to learn. Mm-hmm. But that is exciting rather than depressing, because I think, okay, I can be a lot better in another 10 years than I was 10 years ago. And until I shuffle off this mortal coil, that's what I'm committed to do. I think it'll just impact everything. Money, yes. Relationships, our sense of well-being. If we can learn to be better thinkers as adults, it'll help us.
It's a good ending line, so I didn't want to say anything else.
That's really good. I wanted you to be like, thanks, Dan.
I was going to say thanks, Godfather.
when I'm calling you, we're saying we're your sons. It's a sign of respect. It's
I'm not offended, mate. I'm very grateful.
You invented the niche, so you could be 15 and I would be your son if you invented the niche. Do you know what I mean? No one did before.
I'm still the grandson and you're still the son.
Well, look, like any proud father, I love it when the child surpasses what's done. Yeah. So Damo, I'm in awe of what you do. I talk to everybody about what you do. You are by far and away my favourite finance content creator.
Oh, thanks, mate.
Until you met me.
Well, obviously.
The finance bro.
Finance bro.
Yeah. Yeah, thank you, mate. It's really great to meet you today.
Thank you for having me. It's been nice.
No, it's our pleasure.
It was really good.
We've taken inspiration from Pete's mantra to simplify everything down, and we've created a 2-page document that will give you 80% of everything you need to know about finances. Where'd you find it, Tamaine?
Right here. No, downstairs in the link in the description.
Do not listen to this guy. You find it downstairs.
I don't know why I keep saying downstairs. In the link in the description.
The link
below.
Below.
Not downstairs.
So seedy. Don't go downstairs at T's house.